The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. In today's rapidly evolving financial landscape, constructing resilient portfolios and identifying the right investment themes has never been more critical. With markets experiencing rebounds in equities, ongoing volatility, and growing interest in private markets, investors are asking how best to allocate across asset classes, manage risk, and seize new opportunities. How are portfolio construction strategies evolving over the next few years, and which emerging trends or themes are underappreciated but could have a major impact on portfolios? Well, to find out more, I'm joined by Brian Griggs, Managing Director and Portfolio Strategist at Nuveen. Hi, Brian. Welcome to the show.
Thanks so much for having me.
Thank you so much for joining us. Well, Brian, there have been recent reports of a rebound in global equities, which rose over 9% this quarter, signaling potential recovery after earlier market volatility. Now, despite this, many investors are reconsidering how to diversify across equities, bonds, and alternative assets to optimize risk-adjusted returns. So, given recent market rebounds, how should investors approach portfolio construction across equities, bonds, and alternatives in the current macro environment?
Well, you characterized it well. There's a lot to be positive on right now when it comes to portfolio construction. You have robust earnings growth across regions, elevated yields within bonds, and a Federal Reserve that's cutting rates. But with that said, there's still a little bit of angst amongst the investor community where investors are trying to figure out, how do I build resiliency into my portfolio for the road ahead, for the unknowns? And we think at Nuveen that a big part of that puzzle is incorporating cash flow producing, income producing private markets. There's three in particular that we think are very well positioned right now for investor portfolios. One is private credit, so being able to make floating rate loans to middle market companies and earn a yield for that. Two is owning diversified core real estate, so current cash flowing properties in this environment should perform well. And lastly, certain securitized areas of fixed income and CLOs have a very attractive yield profile per unit of risk.
Okay, well, you've mentioned three different ones there, but are there any other asset classes that you think are currently underrepresented in traditional portfolios, and why would that be?
Well, the investment community spends a lot of time talking about the 60-40 portfolio. So 60% stocks, 40% bonds. And do I think it's broken? No. I mean, the 60-40 portfolio is up about 13, 14% year to date. It's generated about 8% return over the last 5 years. But to say that it's broken, it implies that it's somewhat of a machine that works in all market environments. And I think that's the misnomer. We saw that in 2022 when both stocks and bonds fell in tandem. So a lot of the conversations we're having with advisors and clients is really thinking through how to augment traditional stocks and bonds in a portfolio, specifically to build in more inflation resiliency. Inflation has come down quite a bit since its peaks, but it's still lingering in lots of parts of the world, including the United States. We think it makes sense to incorporate real assets into portfolios that can help fend off those inflationary periods.
Okay, well, I'm going to pry a little bit more on the 60-40 portfolio in just a bit. But how do you see regional diversification playing a role in building resilient portfolios amid ongoing geopolitical uncertainties?
Well, 2025 is a case in point around that, right? We've seen firsthand that it's not just a one-way trade with U.S. dollar assets. So far, year to date, granted, the S&P 500 is up about 13%, which is the benchmark for U.S. equities. But of course, non-U.S. international equities have outperformed by even more of a margin after factoring in currency weakness. So I think it's a lesson for investors. Owning different regions of the equity market in different parts of the world, it's not just about outperformance or diversification. It's really risk management. It's ensuring that in years like this year, when the dollar weakens, you have a diversified equity portfolio that can still produce positive returns across geographies.
Right. Well, some experts suggest that resilient portfolios increasingly require strategic diversification across asset classes, liquidity profiles at regions, and systemic approaches and disciplined risk management are emphasized to withstand volatility. So what strategies or tools are most effective for building resilience in multi-asset portfolios today, Brian?
I would say the most popular one is really thinking about the private market space. Now, private markets have evolved quite a bit from even, say, 10 years ago. 10 years ago, everyone thought about the private market space as a way to generate higher returns in the public market. And you can still do that, to be fair. But I would say today, the conversations have shifted quite a bit, where allocators are really looking at private markets not just as a means to outperform, but to build that strategic diversification resilience that you speak of into the portfolio, build more cash flow potential, build more inflation resiliency, so that when we get those markets where stocks and bonds both struggle at the same time, you have part of the portfolio that's still compounding consistent cash flow returns at high levels.
So circling back here, can we still have that resilience in a 60-40 portfolio today, or is that a thing of a past?
I think there'll be certain markets that the 60-40 will do quite well, and we don't have to look too far to see those markets, right? This year has been one, and certainly going into next year, you still have elevated yields on the bond side. You have robust fundamentals in global equities going into a rate-cutting cycle. As long as inflation remains tamed, I think that's a pretty constructive environment for both stocks and bonds, and particularly if you combine them at a 60-40 weight. The question is, what if Brian Griggs is wrong and we do have a higher inflation pressure? What if tariffs, which are already starting to impact core goods inflation, spills over into services inflation, and it causes the Federal Reserve to change course on its rate cutting cycle? That's not our base case. But the essence of building a diversified portfolio is being humble enough to acknowledge there is no crystal ball. We don't know what the future holds. So we need to hold different types of exposures to prepare us for those unknown unknowns that can happen in markets.
Well, as you mentioned earlier in our conversation, private markets are becoming more central in portfolios. So financial institutions, they have highlighted that private credit and private real estate can offer higher yielding income and lower correlation with public markets. And several banks are also expanding access to private market investments for individual investors. So how do private markets fit into all of this diversified portfolio in 2025, particularly given rising interest from retail and high net worth investors?
Yeah, absolutely. I mean, it's a space that's gained a lot of attention, but we're still in the early innings.
Okay.
So for context, in the United States, this is based on polling data, but the advisor community has been surveyed to say that only about 35% of U.S. advisors use true private market strategies. And of those 35%, the average weight is only about 5 to 10%. So on aggregate, looking at U.S. wealth assets, total private market AUM, it's about 2% of the overall U.S. wealth industry. So I would say there's a lot of room to climb there. Now, there's a lot of talk about democratization of private markets. And I think when people use that term, they're really talking about more products, right? Bringing more things to market for people to buy. But to us in Nuveen, the democratization is also about giving advisors and investors the tools so they can really think about how to strategically blend these public and private markets in a way that ultimately helps their portfolio outcome become more achievable.
Okay. So are there specific private asset classes that you see as more attractive currently?
I would say our most kind of leading ideas on the space, particularly for those that are just getting started in private markets, it's important to have a structure that gives you some liquidity, right? Not no liquidity, not daily liquid, but something in the middle, something that spits out cash flow for you. And there's 3 strategies that really fit the bill there. The first is private credit, as you mentioned before, specifically to middle market backed companies. We think there's tremendous opportunities both in the U.S. and Europe when it comes to private credit investing. The second is core real estate. Real estate is somewhat of the gateway to private markets, we call it, because everyone understands how real estate works, right? You own a portfolio of buildings, they generate rent, you collect the cash flow. So we think that's an area that has been somewhat out of favor the last few years because of concerns around COVID and the interest rate environment. But we think it's poised to come back as we move forward here into 2026. The last I would call attention to is the CLO market, which sounds complicated on the surface, but it's just another credit instrument that allows you to generate higher yields and less interest rate sensitivity than, say, the fixed rate bond market. Those are kind of our 3 base case ideas for first timers in the private market space.
Okay, so you mentioned balancing that liquidity there, but how should investors then weigh liquidity trade-offs when adding private assets to their portfolios?
That's a very individualized exercise, right? It's all about really doing the financial planning work and knowing what is your liquidity need? How much of your portfolio do you need to have in a daily liquid form? And there's a lot of ways to go about that, right? Some people have a certain amount of months of daily cash flow on hand in cash and in short-term instruments. Once you do that financial plan, you have your liquidity needs met. That's when you can really take advantage of these less liquid opportunities with the rest of your portfolio. So I would love to give a specific weight example. I mean, we often talk about as a starting point, what does it look like if 20% of your portfolio is in private markets? But the range from there goes in both directions, right? We see some clients with very high weights in private markets, some with very little. It's all very individual plan specific.
Right. Depending on the individual's risk strategy, right? Or risk tolerance, rather.
And capacity for risk, too.
Yeah.
That's right.
Well, several themes are shaping investment strategy, whether it be AI, tech, or, deglobalization, or even the energy transition. So which macro or thematic trends do you currently consider most critical for portfolio strategy? Is it AI?
It's hard to argue that AI isn't the most important macro theme today and won't continue to be. In fact, a lot of those robust estimates for earnings growth in the US and in China are somewhat driven by this AI theme. So I think we're in the early days with AI. It's certainly a space that continues to gain momentum. And to your point, a lot of the hyperscalers, the tech companies are the ones that are accreting most of the benefits now. But I think there will come a point where the benefits of artificial intelligence are going to start to permeate across the global corporate landscape. Companies will figure out how to use AI to get more efficient, and that's going to be a big driver of earnings growth into the future.
Right. And for those people who weren't able to join that AI hype in the very beginning, would be wondering, are there any other emerging sectors or technologies that you believe are underappreciated by mainstream investors?
Well, I would say AI isn't just a tech trade, right? Like to your point, some of those tech companies involved in the AI space, they're trading at very expensive levels, and some people might feel like they missed the boat.
Right.
But another idea around this theme is the energy needed to fuel the AI boom, right? So investing in the infrastructure companies, the utility companies, particularly in the US, that are critical for supplying all this electricity needed for these data centers and training these LLMs. So that's another key theme that we think is another non-tech way to play the AI boom in a little bit more of a defensive risk-reward manner than just owning the big tech names.
Okay, I'll take note of that. Well, before we let you go here, Brian, if you could give one piece of strategic advice to investors navigating this complex market environment, what would it be?
It's time in the market, not time in the market, right? Ultimately, building a strategic portfolio is about having an allocation that you can sleep at night with, that you can stick with through these market cycles and compound at a consistent rate. That's really the key to generating long-term wealth after inflation for individuals and professional advisors and investors alike.
Time in the market, not timing the market.
I can't claim credit to that. I did not come up with that, but I think it's very true.
Well, it's the first time I'm hearing it, so I'm going to give it to you. Well, thank you so much, Brian, for joining me today.
This was a lot of fun. Thanks so much for having me.
Thank you. That was Brian Griggs, Managing Director and Portfolio Strategist at Nuveen. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.